Howdy, everybody. Welcome to Liberty Call. Today is Tuesday, July 1st, 2025. Hope you're having a fantastical day out there in the interwebs. Was a nice day here. We got some clouds coming in and some thunderstorms, which are not awesome. As you can tell, it's a little darker here in my office today. Well, the markets wrapped up the first half of the year near record highs as Trump's massive one big beautiful bill cleared the Senate and the Fed stayed non-committal on rate cuts. The S&P and Nasdaq inched higher while the dollar plunged to a nearly 4-year low. Treasury yields held steady, but with fresh jobs data looming, the second half of 2025 is set to start with plenty of fireworks. Huh? See what I did there? All right. Anyways, well, before we get into all the news, I need some help from you. If you give me some thumbs up, a like, share, subscribe, a follow, and press that notification bell. All righty, let's jump to the markets for today. Let's see here. Starting out, Dow Jones up 0.91%, 400 points, closed at 44,495. S&P 500 down 0.11, 6 points, closed at 61.98. Nasdaq down 0.82, 166 points, closed at 2202. The VIX up 0.6 today. It's at 1683. Canada up 0.62. Brazil up a half. And Mexico up 0.63. Jumping over to Europe, Germany down 0.8%, UK up 0.28%, France down 0.04%, Netherlands down 0.45%, Spain down 0.03%, Italy down 0.58%, Switzerland up 0.22%, and Portugal up 1.85%. Russian exchanges were mixed today. The MOEX down 0.01%, RTSI up 0.13%. And the overnight markets, the Nikkei in Japan was down 1.24%, Australia down 0.01%, New Zealand up 0.77%, China, the Shanghai up 0.39%, Shenzhen Component up 0.11%, China A50 up 0.25%, DJ Shanghai up 0.35%, and the Hang Seng was not open, and neither was the Taiwan weighted. All right, good stuff. Let's get to our market recap, see what happened there today. S&P 500 slips from record as big tech starts Q3 on the back foot. All right, the S&P 500 slipped from record highs on Tuesday as weakness in big tech and rising Treasury yields weighed on markets. This follows a strong start to the third quarter with the S&P and Nasdaq closing at record peaks on Monday, boosted by easing trade tensions and growing expectations of Federal Reserve rate cuts. Recent progress on trade has supported sentiment, including last week's U.S.-China deal and Canada's last-minute decision to scrap its digital service tax on tech firms. However, U.S. trade talks with Japan have hit roadblocks. The Trump administration is now pursuing smaller targeted trade agreements with select countries to secure quick wins before steep reciprocal tariffs return on July 9th. While these deals could help avoid the harshest levies, a 10% baseline tariff will remain in place. President Trump's aggressive tariff agenda and its inflationary risks, again, I wouldn't agree with that, have complicated the Fed's policy outlook, although weaker than expected inflation data has raised bets for a September rate cut. Fed Chair Jerome Powell has maintained a cautious wait-and-see approach. This has drawn Trump's ire with the president sending Powell a note criticizing him for being, quote, too late, end quote, on rate cuts and suggesting U.S. rates should be at 1% or lower. Boy, because that wouldn't cause any inflation. Trump is a moron. Trump is reportedly considering naming Powell's successor later on this year. Meanwhile, the Senate narrowly advanced debate on Trump's sweeping one big beautiful bill, which is loaded with pork and crap, combining tax cuts, domestic spending changes, and border security measures. The bill would add $3.3 trillion to the federal debt over the next decade. In corporate news, Tesla shares slumped after Trump escalated his feud with Elon Musk, accusing him of profiting excessively from federal subsidies. That is funny. In contrast, Hasbro shares hit record highs after Goldman Sachs upgraded its rating, citing optimism over new product launches. Yeah, the big beautiful bill. I mean, they've taken out, things like getting rid of Medicaid for illegals, things like that, things that, we, the American people, should not be funding. But, crybabies in Washington and, on the left, for some reason think that we should take care of the whole world. All right, next up, this comes from First Trust, the June ISM Manufacturing Index. Mr. Nate Guernsey put this together. Let's see what's going on here. U.S. manufacturing activity continued to contract in June, marking the fourth consecutive month. The ISM Manufacturing Index has remained below 50, signaling ongoing weakness in the sector. This follows a brief rebound earlier in the year when the index temporarily rose above 50, sparking hopes of a recovery. However, persistent uncertainty from U.S. trade policy and escalating Middle East tensions appear to be weighing on the sector. The June report showed mixed results across industries, with half of the 18 major industries reporting growth, 6 contracting, and 3 unchanged. Modest improvements in the production and inventories indices helped lift the overall index slightly, with production reaching 50.3, inventories at 49.2. However, new orders remained a key concern, slipping to 46.4 as businesses continue to pause orders amid tariff uncertainty. Employment in the manufacturing sector also took a hit, with the employment index falling to an 8-month low of 45, and twice as many industries reported job losses as gains. Inflation pressures persist despite the weak manufacturing backdrop, with the prices index rising to a historically elevated 69.7. Meanwhile, construction spending declined to 0.3 in May, driven by weakness in both home building and commercial projects, adding to concerns about broader economic outlook. All right, so it's kind of a mixed bit of information. Move on to a little bit more data here from Zero Hedge. Labor market rebounds as job openings unexpectedly soar. Again, it's the data has been very, very mixed of late, kind of boring, quite honestly. But anyways, let's dive into this. The U.S. labor market showed surprising strength in May, with job openings soaring by 374,000 to 7.769 million, marking the highest level since November of 24 and far exceeding expectations of a decline to 7.3 million. The gain follows an upwardly revised April figure of 7.395 million and indicates a sharp rebound in labor demand. The largest increases in job openings were seen in accommodation and food services, up 314,000, and finance and insurance, 91,000. Conversely, federal government job openings dropped significantly by 39,000 to 89,000. The lowest level since the COVID era, reversing an unusual spike reported in April. Importantly, the gap between job openings and employed workers widened, with 532,000 more job openings than unemployed individuals, compared to just 117 in March, or 117,000 in March. Historically, a recession has not begun when job openings exceed unemployment, suggesting the U.S. labor market may have dodged an immediate downturn. However, there were mixed signals beneath the surface. New hires dipped slightly to 5.503 million from April's 5.615 million, while the number of workers quitting jobs, a sign of confidence, rose modestly to 3.293 million. Some analysts speculate that the improved labor market reflects a decline in the shadow labor market dominated by illegal workers, with more legal domestic workers filling those roles. While the trend may bolster wages, it could also fuel inflation down the road. We'll see. All right. And we got one more article here, also from Zero Hedge. Party's over. Auto sales sputter after tariff-fueled surge. U.S. auto sales slowed sharply in June following a spring surge fueled by consumer efforts to buy vehicles ahead of the Trump administration tariff hikes. According to J.D. Power's, second quarter vehicle sales rose 2.5% year over year as buyers rushed to dealerships before higher prices took effect. However, the momentum faded quickly, with June's annualized sales rate dropping to 15 million units, the slowest in a year, down from 17.6 in April. Industry experts expect the sales downturn to persist throughout the second half of this year. Jonathan Smoke, chief economist at Cox Automotive, warned that worsening affordability will force production cuts to maintain inventory balance. He forecasts monthly sales to average around 15 million units for the rest of the year, compared to 16.3 in the first half. The average new car price climbed 1% in June to nearly $48,800, a staggering 28% increase 2019 levels, fueled by tariffs and inflation, mostly inflation. Used car prices are also rising again as buyers seek more affordable alternatives, tightening supply in the pre-owned market. Looking ahead, Goldman Sachs expects the Federal Reserve to begin cutting interest rates in September, with 3 rate reductions likely by year-end. However, affordability concerns and high prices remain key headwinds for the auto market this summer. All right. So again, kind of mixed information, the ISM manufacturing index had, some parts of the industries were, down. Although the labor market jobs are up, or job openings are up, and then, we have the auto market, which had a short little burst there in the springtime and then is tailing off again. So, all right. Well, that's everything that I wanted to cover for today. So, if anyone needs anything from me, where do you want to go? Do DSAFinancialGroup.com. All your financial planning needs can be addressed there. Give me a call. I'd be glad to help. Hope everyone out there has a wonderful evening, and I'll talk to everyone again next time. Adios.